Stocks just posted one of their strongest weeks in months, and the move was broad enough to matter. The Dow Jones Industrial Average and the Nasdaq Composite each climbed more than 1,300 points over the course of the week. That kind of parallel gain across two very different indexes is worth paying attention to. The Dow is built around large industrial and financial companies. The Nasdaq leans heavily on technology. When both rise sharply at the same time, it usually means investor confidence improved across the market, not just in one sector or one pocket of momentum trades. So what drove it? The short answer is that some of the pressure that had been weighing on stocks eased, at least for now. Markets had been unsteady for weeks, caught between persistent inflation concerns and uncertainty over when the Federal Reserve might start cutting interest rates. That combination tends to keep investors cautious. Money flows out of stocks and into safer assets, like cash and short-term bonds, when the outlook feels murky. When that uncertainty lifts, even slightly, the reversal can be fast. That appears to be what happened here. Investors moved back into equities, and the result was a rally that pushed both major indexes to some of their biggest weekly gains in recent memory. The Federal Reserve remains the central variable. The Fed has kept interest rates elevated in its effort to bring inflation down to its 2% target. Cutting rates too soon risks reigniting price pressures. Holding them too long risks slowing the economy more than necessary. Markets have been repricing their expectations for Fed policy repeatedly this year, and those shifts have driven much of the volatility we have seen. Bond markets will be a key signal to watch, specifically Treasury yields, the interest rates on US government bonds. When yields rise, bonds become more competitive with stocks, and that tends to put downward pressure on equity prices. When yields hold steady or drift lower, it generally supports the case for stocks. Stability in the bond market would be a positive sign for this rally's durability. The US dollar will also be worth monitoring. A stronger dollar can create headwinds for multinational companies that earn revenue overseas, a factor that matters particularly for large-cap technology stocks. The next test comes from the data. Upcoming reports on inflation and the labor market will give investors and Fed officials fresh information to work with. If inflation continues to cool and the jobs market stays resilient without overheating, the conditions for a sustained equity recovery improve. If the data surprises in the other direction, this week's gains could face a quick reversal. Watch the inflation and jobs numbers. They will tell you more about this rally's staying power than the points on the board. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.